Hey everyone, and welcome. So you've probably heard people talking about investing. Maybe it sounds complicated, like something only people in fancy suits on Wall Street do. But what if I told you that investing is actually for everyone, including you, and it's one of the most powerful things you can do for your future? Stick around, because by the end of this video, you'll understand what investing is, why it's so important, and how you can get started, even with a small amount of money. Let's break it down to the absolute basics. What is investing? Imagine you have a seed. You could just keep that seed in your pocket forever. It's safe, but it will always just be a seed. Or you could plant it in some good soil, give it water and sunlight, and watch it grow into a big, strong tree. A tree that not only gives you more seeds, but also produces fruit year after year. Investing is planting your money so it can grow into more money. Instead of letting your cash just sit in a savings account, where it might not even keep up with the cost of living, you put it to work. You're essentially buying a small piece of something you believe will become more valuable over time. So, why should you even bother? The biggest reason is something magical called compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Here's how it works. When you invest, your money earns returns. Then, those returns start earning their own returns. It's like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow and gets bigger and bigger, faster and faster. Let's imagine to friends Alex and Ben. Alex starts investing just $100 a month at age 25. Ben thinks he has plenty of time and starts investing $200 a month at age 35, assuming they both get the same average return by the time they're 65. Alex will likely have significantly more money than Ben, even though Ben invested more cash each month. Why? Because Alex's money had 10 extra years to compound and grow. The lesson here is that time is your greatest asset. The earlier you start, the less you have to invest to reach your goals. It's not about timing the market, it's about time in the market. Okay, so the idea of your money making money sounds great, but where do you actually put it? Let's talk about the most common types of investments for beginners. First up, we have stocks. When you buy a stock, you're buying a tiny piece of ownership in a public company. Think of big names like Apple, Amazon, or Disney. If the company does well and makes a profit, the value of your piece, your stock, can go up. You can then sell it for more than you paid for it. Of course, if the company doesn't do well, the value can go down. This is why investing in just one or two individual stocks can be risky. If that one company fails, you could lose your investment. This brings us to our next option, which is a fantastic starting point for beginners: funds. Specifically, let's talk about mutual funds and exchange-traded funds, or ETFs. Imagine you want to buy a bunch of different fruits, but you only have $5. You can't afford to buy a whole watermelon, a full pineapple, and a big bag of apples. But what if you could team up with a bunch of other people? Together, you pool your money and buy all those fruits, and everyone gets a little bit of everything. That's what a fund does. It pools money from many investors to buy a wide variety of stocks, bonds, or other assets. So, instead of betting all your money on one company, a fund spreads it across hundreds or even thousands of companies. This is called diversification, and it's your best friend in investing. It helps to reduce risk because if one company in the fund isn't doing so well, it's balanced out by all the others that are. Index funds and ETFs are super popular because they often have very low fees and aim to simply match the performance of a major market index, like the S&P 500, which represents the 500 largest companies in the US. It's like getting a slice of the entire market in one simple purchase. For most beginners, this is the way to go. Then there are bonds. If buying a stock is like owning a piece of a company, buying a bond is like lending money to a company or a government. In return for your loan, they promise to pay you back the full amount on a specific date, and along the way, they pay you interest. Bonds are generally considered less risky than stocks, so they're often used to add stability to an investment portfolio. Now, I know what you might be thinking. This all sounds good, but I don't have thousands of dollars to invest. Great news! You don't need it. We live in an amazing time where you can start investing with as little as $1. Thanks to modern brokerage apps and the concept of fractional shares, you can buy a small slice of a share instead of the whole thing. So, if one share of a company you like costs $500, you can invest just $10 and own a small fraction of that share. This has completely opened the doors for everyone to start building wealth. No matter their starting point, the most important step is simply to start. Don't fall into the trap of analysis paralysis, where you spend so much time researching that you never actually do anything. The best way to learn is by doing. So, how do you take that first step? First, you need to open an investment account. This is usually done through a brokerage. There are many reputable, low-cost online brokerages out there. Do a quick search for best beginner brokerage accounts in your country. Look for one with low or no fees, no account minimums, and a user-friendly app or website. Opening an account is usually a straightforward online process, similar to opening a bank account. Second, decide on a strategy. A simple and effective strategy for beginners is called dollar cost averaging. This means you invest a fixed amount of money at regular intervals, say $50 every month, regardless of what the market is doing. When the market is down, your $50 buys more shares. When the market is up, it buys fewer. Over time, this averages out your purchase price and takes the emotion out of investing. You're not trying to guess the perfect time to buy. You're just being consistent. Automate it. Set up an automatic transfer from your bank account to your investment account every payday. Set it and forget it. This is how you build wealth quietly in the background. Now, let's talk about the elephant in the room: risk. Yes, all investing involves some level of risk. The value of your investments will go up and down. This is called volatility, and it's a normal part of the process. You will see red days where your portfolio is down. The key is not to panic. Remember our tree analogy. A tree doesn't grow in a straight line. It faces storms, windy days, and dry spells. But as long as its roots are strong, it continues to grow over the long term. History has shown that over long periods, the stock market has consistently trended upwards, despite major crashes and recessions. People who stay invested through the downturns are the ones who benefit from the recovery and continued growth. Panicking and selling when the market is down is the surest way to lock in your losses. Your mindset is crucial. Think of yourself not as a short-term trader, but as a long-term owner of great businesses. A quick but important note: before you start investing, it's wise to have a couple of things in place. First, a safety net. This is an emergency fund with about 3 to 6 months worth of living expenses saved in an easily accessible savings account. This is your cushion for life's unexpected events, so you won't have to sell your investments at a bad time. Second, try to pay off any high-interest debt, like credit card debt. The interest you're repaying on that debt is likely much higher than the returns you can expect from investing, so tackling that first is a smart financial move. Investing isn't a get-rich-quick scheme. It's a get-rich-slowly and steadily plan. It's about discipline, patience, and a long-term perspective. It's about buying yourself future freedom. Freedom to travel, to retire comfortably, to pursue your passions, or to simply have less financial stress. So let's recap the simple steps to get started. 1. Build a small emergency fund. 2. Open a low-cost brokerage account. 3. Set up an automatic, recurring deposit, even if it's just a small amount. 4. Invest that money into a diversified, low-cost index fund or ETF. And 5. Be patient and think long-term. Let compounding do its magic. You have the power to change your financial future, and it starts today. Don't be intimidated. Every expert was once a beginner. The journey of 1,000 miles begins with a single step, and your first step is simply deciding to start. You've got this. Thank you so much for watching. I hope this video cleared things up and made you feel excited and empowered to begin your investing journey. If you found this helpful, please give it a thumbs up and consider subscribing for more simple finance videos. Let me know in the comments if you have any questions or what you'd like to learn about next. See you in the next video.